But we've got an expert on the line, so
We do. So let's get him going. Thank you, Michael. Yes, the expert, ladies and gentlemen, I present to you, Adam Blumberg of Interaxis.io. We had a quick joke that we wanted to insert here as well. I was born on March 18th. Adam was born on March 18th. So that's two great Adams born on March 18th. And Adam Levine of Maroon 5 was also born on the same day. So for all you groupies out there of Maroon 5, thank you for joining us today. Ladies and gentlemen, Adam is a certified financial planner and RIA owner in Texas. He has been in the financial services industry since early 2009, starting as an insurance broker / dealer. In 2014, Adam and Ron Dixon founded Chart Wealth Management and left the insurance business for independence. In mid-2017, Adam and Ron started to dabble in cryptocurrency, first Bitcoin and then Ethereum, and later into altcoin trading. Adam had to learn more about the industry and cryptocurrencies, how they existed, and spent many months researching this blockchain technology of which we speak of. In early 2019, with the growth of decentralized finance and security tokens, Adam and Ron started speaking at conferences as some of the only financial advisors to understand the space. And Interaxis was started as a YouTube channel early in September of 2019 and is now a company focused on education and adoption of decentralized finance and blockchain technologies. Adam lives in Houston for now with his family. He's a graduate of the University of Texas at Austin, Hook 'em Horns, and has a degree in finance and honors business. Ladies and gentlemen, I present to you Adam Blumberg, who, as I said, is giving us our first ever whiteboard presentation here at the Chicago Blockchain Real Estate Collective. Adam, the floor is yours.
All right. Thanks. Thank you so much, Adam, for the warm intro. Thanks, everyone. And again, let me know whatever questions you have. I'm going to try to go through this. Some of this is actually just ad hoc, kind of listening to what you guys have already talked about and what you guys have already done, and thinking about real estate and security tokens, and really how we look at, as we call this, digital assets, not cryptocurrency. So you alluded to before the fact that we really have to get people on board with the fact that a security token is not cryptocurrency. But it's important that the rails that were created by Bitcoin, right? So everyone needs to kind of understand the Bitcoin rails, the idea of wallets, the idea of the decentralized rail, and really the ethos of Bitcoin. What it tried to create was this idea of a decentralized economy, the idea that we can transact on a potentially a peer-to-peer basis, and we can disintermediate. We can take out a lot of those intermediaries, right, that are causing us a lot of the fees and a lot of the friction that you all alluded to. Now it was alluded to earlier on that a lot of what we see in real estate, we're financial advisors, right? So we a lot of times obviously get pitched real estate investment trusts for our clients, and other illiquid assets like real estate. And the benefit, of course, to illiquid assets like real estate is usually you get some sort of increased return, you get a little bit better return. It is non-correlated. That's one of the best aspects of something like real estate or some of these other, I guess what's called alternative investments, is non-correlation. They're not correlated usually with the rest of the market. And so as, of course, the rest of the market is doing this, you might have an asset that's just going right through the middle and you're continuing to get income. You all know this, you all invest in real estate. But of course, the downside is at any point, once you've invested in a building or real estate or a REIT or something like that, you can't get your money out. So liquidity is a big problem. Liquidity has been a big problem for us in terms of getting clients to want to invest in some of these alternatives. Liquidity is always a big problem. This question of, can I get my money out? How do I get my money out? If I want it, and the answer is usually you can't, because there has to be some sort of redemption. And in order for there to be a redemption, you're going to take a huge haircut, because you're going to have to sell your real estate back to the firm, back to the management group. So where we got excited about the idea of security tokens and real estate, the idea of digital assets and not just cryptocurrency is now what you're doing is you are taking, instead of just having this crypto world over here, where all the assets are Bitcoin and ETH and all these things that all these assets that we think of as being highly volatile, as being potentially manipulated. And then you have equities in here, right, which is publicly traded companies, move up and down with the markets, very relatively transparent as to their earnings, as to their revenue, all those. However, they're can be kind of slow moving, and obviously obviously they are correlated to the market. They are the market. And then you have things like real estate. You have oil and gas. I'm from Texas. Obviously, we're going to talk about oil and gas, right? You potentially have bond funds. You have some sort of debt instruments over here. Now, again, you want access to all this, but people think of it as crypto, right? Because it might be a security token. However, the idea of taking these rails and incorporating all this and bringing the value that's created over here on chain is just huge, because now you have real assets that are moving around this decentralized network, getting rid of fees and friction. And now maybe we have this light at the end of the tunnel called liquidity. And once you have liquidity, then you can really unlock a lot of the value. Then you can really have more people investing in assets like real estate, in things like debt, right? That people just don't understand, because you can create an asset that incorporates real estate, debt, and such. So that being said, there have not been a tremendous, unfortunately, not been a tremendous amount of security tokens created, especially to represent real estate. Real estate is seen as kind of the big one, right? That's the most obvious way. That's the most obvious place to tokenize, because you're taking something that you can't get more real than real estate. You can't get more real than something you can stand on, or something you can hit like that, right? This is a real asset. This is value. This has income. This has people paying rent. This has real expenses. And we know how many fortunes have been made in real estate. My father has been in multifamily his whole life, so we know all about it here. But being able to take these crypto rails, right, the idea of cryptocurrency and attach security tokens has so much value to it that, again, that many of you already know, but now we're starting to see it pick up. So early 2019, when we got really excited about it, security tokens were getting kind of hot. And then regulation hit, right? And the reason why it slowed, and the reason why all of you are kind of frustrated that we don't have as much yet, is because regulation became this gray area. No one was quite sure where security tokens were going to fit. And the big issue was, okay, if we have these security tokens, one, you have to go through the same regulations, right? You have to go through, is this going to be some sort of Reg D type offering? How many investors can I have? How much money can they put in? Do they have to be accredited? You had all of those sorts of issues. Then, is it considered a security or not? Right? That had to be kind of answered. And then one of the biggest issues was, okay, how do we take all this and encode it in some sort of token, right? And once we have it encoded in that token, what can we do with it? And what we had to wait for were some of these markets, some of these exchanges to get their transfer licenses, to be able to be transfer agents. That was the big deal. That's what we kind of were waiting for, to be able to say, okay, we can put this token on an exchange like Open Finance or like T0, and we're going to take all the rules and regulations, we're going to take all the LLC paperwork, encode it in this token, we're going to put it on this exchange, and after some sort of lockup period that's part of these rules, we're going to allow these exchanges now to let you in and come buy this token from me. Okay, and that is hopefully where we see this going. Now, keep in mind that that might be a 12, 24, 36 month process now, because in 2019, we all got very excited about it. We thought we thought 2019 was going to be the year of the security tokens. I'll show you the tweets that I have that people said 2019 is the year of the security token. Hey, it didn't come out that way, and mainly that was because of regulation. Partially, it's because people didn't understand the difference between security token and cryptocurrency. And part of it was because the open finance or decentralized finance rails weren't all completely built out yet.
I'm gonna interject here real quick too, Adam. You're doing great. We got roughly about 20 minutes left.
Okay.
Real quick, what's your Twitter?
Interaxis8.
Interaxis8. Michael Flight too had a quick question. I just want to again encourage everyone else listening here to utilize that chat box as we proceed. Put your questions in there because, as I mentioned, we got about 20 minutes left. So, Michael, did you want to ask Adam real quick before he goes on?
Sorry. Yeah, Adam, we just kind of found out over our investigations that one of the really cool things about security tokens is you could either invest in them with US dollars, or foreign investors can invest in them with other fiat currency like yen or euros, or even, investors, if they had crypto and were looking to get some sort of stability or cash flow, they could invest in security tokens. But the really cool thing was that we found out you could also choose to get your distributions or your income, your cash flow paid out in a different currency. So you could invest in dollars and then get it back in euros or ether. Has that been your experience?
Yeah, I mean, it's not that much different than any other sort of LLC and than any other sort of investment. You're going to the manager, whoever issues the token, is going to kind of decide those rules, right? And as long as you have the investment coming in, right, and then you have this management and you have the distributions going out, they can do whatever they want in here, right? If it's US dollars coming in and you want it in euros, right, they just make the exchange in here potentially. That's real easy. Now, even easier is if you say, I mean, and someone here said they invested in realty, right? You could put DAI in here as a cryptocurrency stable coin and get paid out in DAI straight to your crypto wallet, right? So that, I mean, for a lot of people, they go, wow, now you're talking about super risk, right? Now I'm adding risk to it. But what this actually does is increases the potential investment pool and even increases the potential for trading being able to trade the token later. Okay.
I think it opens up a whole bunch of liquidity, and the really cool thing is if you're concerned about, what's going to happen with the dollar, if you're taking your distributions out in another currency, it's a nice way to hedge, on the dollar. So that's what we really were excited about.
And look, and the important thing to note is security token, you're not investing in a security token. You're investing in a security. You're investing in an asset, right? And that asset has to perform, and someone has to manage that, regardless of what they do. And if they decide it's okay, we're going to get more investment if we're able to take in dollars and pay out euros, then that's fine with us. Now, they have to manage that process. And if part of them taking in your dollars and paying you out in euros means they're taking on some sort of currency risk, then you have to realize that might affect your return. It's not like, because they might have to hedge the euros somewhere in here. They might have to get some sort of options or something within this box to be able to pay certain people in euros, right? Because you don't want to take that currency risk, but they don't want to take it either. That's not their job. Their job is to manage real estate, right? So that's part of, but that all being said, that could be part of the beauty of the cryptocurrency world and the addition of that. And we don't want to get too far down this path, of course, of going, man, we can make all of this crypto based and all of this on chain. But the great part of this, the thing that's really exciting about it, and again, I don't want to get so excited that we think that we're investing in a security token when in reality, we're just investing in real estate, or we're investing in oil and gas, or whatever it might be. Okay, but when you start denoting it with this token, and this token is on some sort of chain, and that chain could be Ethereum in the case of an ERC20 token, and you guys stop me if I need to move back any more and discuss this. It could be Tezos, which is, obviously really moving far along in terms of security tokens. It could be Raven Coin, whatever it might be. But now you have so many aspects that you didn't have before necessarily in real estate or in other assets. So on one hand, I use, like I said, I use my father all the time as an example. He hasn't created a security token yet, but my father's in the multifamily housing business. He has been for 30 something years. And so I keep trying to get him to do this and he won't do it. However, the really cool part and the way I think about it with him is he's really good at what he does, okay? And he goes and raises money over here for one project, not for a fund like you guys are trying to do, but he has to do it per project. He goes and raises a bunch of money, that money comes in here, and then he's got to go manage the project. And if the project does well, he kicks off distributions to these people, and eventually, hopefully, he gets to sell this project for more than they paid for it, and his investors get a great return, right? In the meantime, it's in kind of this black box. They can't get their money back out, okay? And they get whatever data that he sends them, okay? And he's got to manage this project. Now, he's got another project over here too, all right? Might have the same investors, might not. Now, in this case, he's got to spend a lot of time raising money and making distributions and appeasing these people and getting the data and all that. A lot of things that he's not the best at. He's the best at finding the projects and managing those, at finding the apartment complexes and managing them and getting their rents up. He's not that good at raising money. Believe me, I've talked to him about it. He's horrible at raising money. He is the worst networker I've ever seen. He's really good at managing these projects. That is where it adds value, and that's what you want him to do. So imagine if he could take all of these as him, okay, and now as a fund, and get to say, look, I want to raise a whole bunch of money for a fund, and the reason why you want to invest in me is because I have a really good track record. And he can go do that now, potentially, of course, because he can create a token. He can have his investors putting money into his fund, which issues a token. We'll call it the Gary B token. His name's Gary, obviously. The GB token, okay? And now all his investors have wallets and they get GB tokens, okay? And as these projects are paying dividends, of course, they're paying dollars, right? Because people pay rent in dollars. He then just in the background has to go, oh, I might convert that to DAI or whatever and start paying all these different tokens in DAI. Now, the cool part is, in the meantime, like these guys, the way it's currently done, the only way they get to liquidate, the only way they get a liquidity event is if he sells the project, right? If there's a liquidity event, someone comes and buys it, hopefully, and they get all their money out. It would be great if they could have some other bit of liquidity. So if they invested $50,000 and they said, look, I want 25,000 back. My daughter's got a wedding. My kid's going to college. I need a car, whatever it might be. Then they might want some sort of liquidity. So that's where we get a secondary market, hopefully, for these tokens. And if they go, look, I can go sell, $25,000 worth of tokens over here on this exchange. In its current state, they can't do that. They can't sell half of their investment. And the reason why is because it would be pardon my French, it's a pain in the ass for my dad. He's got to value it. He's got to do all the paperwork. He's got to repaper and everything, and it's a pain. But if they can just sell their tokens and it's all done through a registered transfer agent, right? He's just paying to the token. He doesn't care if it's in this wallet over here or that wallet there, or that wallet there. All he knows is manage the project, bring in the rent, pay the distribution to the token. The token is in whatever wallet. He doesn't really care. He can go about his job of managing. And if this project sells for a whole bunch of money, he can decide to make extra distributions to these tokens, or he can decide to keep it and invest in another project. The other great part is this is all on chain, ideally, right? So the token holders could essentially get so much data that they see what's happening to their investment all the time. It's incredibly transparent, ideally. Now, what that also means is you have to have the data, right? So you have to have someone else, hopefully, and there's actually, I don't know if you know of the company Invenium, but there's a company called Invenium, which actually specializes in on-chain data for assets like this. So they will go to buildings, they will go to office buildings, especially commercial buildings, multifamily, whatever, and they'll get all that data that is actually pretty available, and they'll put it on chain. Well, now if he could take that data and put it on chain, and everyone could have access to what's going on with his token, which is essentially all his real estate projects, well, now you know exactly what the value is of this, right? You can create some sort of algorithm, some sort of software that goes and reads all these tokens, reads all the data that's on them coming from here, and you know exactly what the value is. And you might go, look, I'm looking for some sort of real estate investment that is denoted, obviously denoted in a token, but I want a real estate investment that is paying 8%, that has X amount of growth, and here's the data I want, and it'll cull through all these different security tokens. Of course, this is in the ideal world, like 5 years from now, and find you the ones you want, and find you your own little basket of investments. And if you really want to go down the cool DeFi fun rabbit hole, which I like to do, and then I have to bring myself back and realize we're only in 2020, right? Then you add in certain DeFi elements. And this is where time, my time as a financial advisor comes in, because I go, wow, wouldn't it be great if my clients could have this super uber hyper customized portfolio? Okay,
and
so
how do you spell DeFi, Adam? It's just DEFI, correct?
DeFi for decentralized finance.
Okay.
And before we go down the DeFi rabbit hole, which I'm really excited about, this first time we've definitely talked about it here. Guys, no question is a stupid question, as they say. So feel free to fill up the chat box. We got 10 minutes left. So even if you have something like not even having to do with DeFi, go ahead and put it in there, and we'll get it over and have Adam answer it before we end today. So anyways, Adam, back to you.
I just want to nominate Adam as the wizard of the whiteboard. So this is fantastic. Thanks, Adam.
Did you just say that? My business partner, Ron, calls me the wizard all the time. He tries to, every time we have a video, he draws a little hat on me. But anyway, I'm going to tell him you said wizard of the whiteboard. He's going to really enjoy that. So do you all know what DeFi is?
Why don't you explain it a little?
Let's explain DeFi. So really it exists on the Ethereum blockchain for the most part, although it's getting to other blockchains. So DeFi, of course, stands for decentralized finance. And it's the idea of taking this peer-to-peer network that was developed on essentially on Ethereum and giving us the ability to utilize it. So from a crypto perspective, you know that you use a wallet, right? The wallet is the software that you use to hold your tokens, okay? So when you have DeFi, it has taken Ethereum and given us this ability to connect everyone here and create all these transactions. So in DeFi, you have lending capabilities, and you have, for instance, lending pools, all right, where I can contribute money in here, and it might be in the form of ETH, it might be in the form of DAI, whatever it might be, and I can contribute to this lending pool, and I get paid an interest rate. And what's happening on the other end is people potentially are borrowing, right? And when they borrow from here, they have to contribute. This is a smart contract, meaning if they don't fulfill what they want, they have to lock up some sort of collateral. And the collateral is really important in here, because the idea is we want to facilitate peer-to-peer lending, but we want to facilitate in what's called a trustless way. And that doesn't mean I don't trust you. It doesn't mean, what it means is I don't care who you are. I don't want to care who you are. because the relationship of my lending you money physically, like if you and I know each other, that relationship is great, and I can lend you money, and I can trust that you're going to pay me. Otherwise, I'm going to shame you next time we go to the country club or whatever. However, that relationship doesn't scale very well. This allows it to scale because of what it says is we can lock your collateral up in some sort of smart contract. And that collateral in this case usually is cryptocurrency, right? So I can lock up some ETH here in a smart contract. You can borrow money and you're going to pay 12% interest to borrow that money. And if you don't pay it back, we're just going to take your collateral, right? Because it's cryptocurrency. So it's programmable. We're going to take it and we're going to distribute it to these people. And that's why we can keep this at a 10% rate of return for contributing capital. Does that make sense to everyone? That is like the easiest, the most basic form of DeFi. Now you can see where this can be extrapolated, right? It can be literally peer-to-peer, my lending you money, you're lending me money. We create a smart contract that binds us together. It can be where this is a pool right here that is essentially a bank, right? Isn't that what a bank is? It takes money from one side and lends it out the other side. That's exactly what a bank does. We just cut out all the fees and the friction in the middle by connecting wallets to it. Now, how cool will it be when this collateral can be security tokens, right? This can represent real estate now because the security token can be an Ethereum token. It can be an ERC20 token, okay? And it can represent real estate. So how great would it be if you have this real estate token that for instance, your realty tokens that represent your ownership in a home in Detroit that's paying you income, and you can go into this pool, for instance, and go, look, I want to borrow $1,000. I got $2,000 in value in these realty tokens. Can I borrow 1,000? I'm going to wrap up my realty tokens here as collateral. And if I don't pay this back, you get to keep $1,000 worth of my realty tokens, right? Won't that be a cool thing to do? Because right now, obviously cryptocurrency is really hard to use as collateral for any sort of loan, and real estate investments like that are not that easy to, I mean, real estate can sometimes be used as collateral, but how hard is it for a bank to actually foreclose? How hard is it for a bank to come get that collateral? It's a painful process. This actually makes it really easy, which makes it much easier for you to go utilize that as collateral to go get a loan. So now what we see is investors might have a easier time thinking about making that investment in these other real assets. And I keep saying real estate, this could be any sort of real world assets. It could be factoring, it could be trade finance, it could be invoice factoring. And then they can use those assets, again, they can sell some of them on an exchange, or they can use them as collateral to get a loan. Maybe they don't want to pay the capital gains tax on it. And they go, oh, well, I'll just get a loan against it. And someone is obviously going to lend me the money because if I don't pay, they can take my tokens. Why can they take my tokens? Because the company, the market maker, the exchange that's holding these tokens is a transfer agent. And what they say is, once this realty token is locked in here, if I don't pay, this gets liquidated. The realty tokens go to Adam now, from Michael to Adam, and the transfer agent up here recognized it, so it's legal. The manager of this real estate, they don't care. They're just paying to the token, right? They can go on managing their business. They don't have to know that you didn't make your payment on your loan and I foreclosed, and by foreclose, that means I hit a button and your real estate came to me by virtue of a smart contract. They don't have to know that. They can go on with their job managing their business. So by cutting out so much of that friction and so much of those legal issues and so much of those fees, you can actually create so much more efficiency in the market. You also open up more participation. By virtue of this, you open up internationally, potentially, people who want to be involved. Now, as I say, this is still a security. It's still governed by laws. We still have to keep it safe. This is not the Wild West. It's not ICOs. It's still accredited investors. All of those things are still there, but you make it that much more efficient, and you make it that much easier for people to get involved, to get out, and you make it much more attractive. And from the world of the financial advisor, making investments more attractive to investors, things like liquidity, things like the ability to use them as collateral and get a loan are huge for investors, especially when they don't know how to find this space and they go through an advisor. I'm going to let you ask a question now.
There we go. Thank you. That's really helpful. Anyone, I mean, I know even for myself, first time hearing about DeFi, and you did a fantastic job explaining it, Adam. If anyone has follow-up questions there, you can either ask now or remember to contact Adam. We're going to have email addresses for everyone in the show notes.
YouTube channel. We have like 100
YouTube channel.
on the YouTube channel now.
There you go.